Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to cover the basics of velocity banking. So what is velocity banking? It is a cash flow management strategy and philosophy that will allow you to easily pay off your debts in record time without really changing your lifestyle, which in turn will allow you to pay much less interest than you normally would, and you'll be able to easily maintain control and liquidity of your money. So, first things first, what do we need to do to engage in velocity banking? First, we need a budget. So here we have the average American's budget, $5,000 of income, $3,000 expenses, $2,000 of savings. Now, I did lie a little here because if you look at the most recent statistics, the average American lives paycheck to paycheck. But we'll just assume for this person, we have $2,000 savings a month. Next thing we need is an expense breakdown. So here we have a student loan, a car loan, rent, and other things. What's really important when you do the expense breakdown is making sure that every single line debt that you have, whether it's a loan or a credit card or whatever, is listed as its own line item. Because every loan that we have or every debt that we have is essentially eating up our cash flow, and our main goal is to make sure that we eliminate that debt so that we can increase our cash flow. Okay, so now that we have our budget, so this is $3,000 of expenses, $5,000 of income, we need our tool. So we need what we call a line of credit. And there's various types of lines of credit. There's personal lines of credit, there's business lines of credit, there's home equity lines of credit, there's credit cards. Credit cards are a line of credit, although they have nuanced differences as how they work compared to the other types of line of credit. But basically, a line of credit is a financial tool where we can easily borrow money, pay it back, and then once we paid it back, we can easily borrow again, right? So you know how a credit card works. That's a line of credit. Compared to a loan, which is one-way street. So with the loan, if I borrow money and then I repay it back, I can never really reuse that money again unless I get a new loan or I refinance if I haven't really paid back the entirety of the loan. Okay, so let's say in this example, I'm able to get a $25,000 personal line of credit with a 15% interest rate. Now, the type of credit line that you'll get and the amount available to you really depends on your personal situation, whether it's your income and your credit profile. Banks will look at that when you apply, and then they'll determine, this is how much you're able to borrow from us. So let's say in this example, I got a personal line of credit, 15%. And this will be our main tool to pay off our debts. So our main tool is not our checking account anymore. So for this average American, money's coming in a checking account and all the expenses are paid out from the checking account, right? What we're going to do is we're going to put all of our money in. Eventually, it will go into the line of credit. That money, even if it comes to checking account, we're going to dump it all into the line of credit. And then we're going to pay our expenses from the line of credit. So here, we're going to still have the same paycheck, so $5,000, right? And then our expenses, okay? So let's just hold on to this for a moment because we're going to figure out which debts are we going to eliminate. So our goal is to eliminate as much as our debts as possible and transfer into the line of credit because every debt that we eliminate increases our cash flow, right? And here we have a question, can we easily pay off these loans within a year? Let's see if we can do that using this velocity banking strategy. So now what we're going to do is we're going to move this debt, both of these, because we have a $25,000 limit, and this, if you combine these, the balance are 23,000. So 23,000 is now the balance. And we're going to do a debt transfer. We're going to move the loans to the line of credit. So let me go ahead and eliminate this. And so what happens when we do that? Our expenses have essentially decreased from 3,000 to 2,000, right? We got rid of these debts and now it's $2,000 of expenses, right? Now, another thing that I want to stress is that we're really not going to have any savings, right? Because savings is essentially just idle money. What we're going to do is we're going to put our entire paycheck into the line of credit, take out the expenses when needed, and then just rinse and repeat over and over again, right? So essentially, when we do that, our cash flow, which is $3,000, is gonna be our driving force that's going to decrease the balance of the line of credit. So we have $25,000 credit limit. We have $23,000 balance. We put our entire paycheck, which will make the balance $18,000. And then eventually, as our expenses creep up, the balance will go up $2,000, making it a $20,000 balance at the end of the next month. So here we're at month 0. Now, let me just do a quick Excel formula to calculate the next month's balance. So it'll be H2 minus 3,000. So after each month, our balance will go down by our cash flow, which is 5,000 minus 2,000. So we're not going to have any savings anymore. We're going to put everything in the line of credit. And as you will see, so next month will be 0. As you will see, if I put in the number of months that it took for me to limit the debt, we're able to easily eliminate the debt within 1 year. Isn't that crazy? We did it pretty much in 7 months. So we eliminated these 2 loans, put it into our line of credit, and then increased our cash flow by $1,000, right? And then what we do is we take our checking or our paycheck, put it into the line of credit, which will decrease the line of credit balance because the interest is calculated by the average daily balance. And then eventually we take our expenses from that. And also just be considered that the monthly payment, the minimum monthly payment is already satisfied. So it's not really taken into account into the expenses breakdown. We don't really have to care about it just as long as we put our entire paycheck in. So now it goes down by $3,000 and it took us 7 months to pay off the debt. Now, obviously, to use that line of credit, we do have to pay interest. And so we're just going to do an estimation of the calculation of the interest by multiplying the previous month's balance by 15% and then divided by 12. Because this is the way most people get confused by the interest rate. Usually when you do a monthly, you want to calculate the interest rate for the month, you divide by 12, but they give you the annual interest rate. So it seems much higher than it would normally be. So let's go ahead and calculate the interest. So that would be the previous month, so H2 times 0.15 divided by 12. And then we're going to do that for every single month. And yeah, so let's go ahead and sum up this interest, which will give us a estimation of how we're going to pay. It's not going to be the exact interest because the amount of interest that you pay is based on the average daily balance, and we don't know in this example, we're just going to make it really simple. All right. So basically, in order to use that line of credit to pay off our loans in 6 months, all we have to do is pay about $1,000 to pay off these 2 loans, $22,000 within a year. Isn't that crazy? That's such an easy way to pay off your loans and increase your cash flow. Now, here's the other cool thing, right? Now, let's say, some people will argue, hey, I could just directly pay off the loan, right? And you can do that. You have $2,000 a month and then you could overpay the loan. But what happens if you ever need a little bit more money? Let's say you dumped your $2,000 into the loans and then you have an extra expense, whether your car breaks down or something like that or whatever, an extra $10, $100. Can you ever call the loan company and say, hey, I need the extra money back? Sorry, I kind of overpaid. Nah, they won't let you do that. But with a line of credit, you can just reuse the balance that's available. So let's say maybe this month, instead of having $3,000 cash flow, you only have $2,500 and then you need an extra $500 in expenses. You can, no problem because the credit line allows you to maintain control and liquidity of your money. So just be aware that I find this method to be superior than just overpaying the loan. So this is velocity banking 101 in the nutshell. Ask yourself, is there anybody out there who's been able to pay off, let's say, these types of loans within a very short amount of time? Very few people don't. And that's why a lot of people live paycheck to paycheck because they have so many loans, student loans, car loans. I didn't even include a mortgage here, mortgage. And then they engage in what we call segregation of income. Your income is so segregated that every debt that you had will pretty much eat into your cash flow, right? And if you do have savings, that savings, you're essentially losing money because the loans that you have a much higher interest rate than the interest that you get in your savings. Whereas your savings here, even though it's zero, is used to pretty much pound down the interest or the balance of the line of credit. All right. So let me know if you have any questions. Please put them in the comment box. And also, if you're interested in joining our group, there is a Google form link. Please click that link and we'll be able to get in touch. So have a great day and we'll speak soon.